Hi, everyone. Today, I'm going to be talking a little bit about insurance and climate change and how pricing climate risk correctly can help build resilient communities. Before I get started, I'll give a quick intro to myself. So my name is Lauren van Oss. I'm the founding product manager at a climate tech company called FutureProof Technologies. We are building the world's first environmentalist insurance company, which means that we're building climate conscious insurance products, and kind of everything that we're building is built through a lens of being good climate citizens and encouraging climate resilience as part of kind of our DNA, and how insurance is kind of built and approached. Prior to FutureProof, I was the product manager at a number of different startups throughout my career. And most recently, prior to FutureProof, was at another insurtech company focused on an entirely different part of insurance. But I've been in the insurance world for a few years now. So I have a little bit of context on insurance in general, and we'll be giving kind of a brief background on the importance of insurance kind of as part of the economy, to kind of level set before we get into how exactly insurance and climate change are intertwined. All right, so like I said, let's kick this off with a little bit of a level set on insurance and why it's so important. Insurance is really the backbone of our economy. Without it, most economic activity would kind of come to a standstill. Families wouldn't be able to afford to buy homes. People wouldn't be able to afford the risk of driving their vehicles on the road. Entrepreneurs and business owners would be at risk of losing everything that they worked hard to build in one fell swoop with a single adverse event potentially. So, kind of at its most basic level, insurance is a business of risk management and risk transfer, and enables individuals and businesses to kind of move risk off of their own books onto another entity, and enables them to do business. And so how all this works is that risk management professionals known as actuaries analyze the statistical likelihood of an adverse event occurring, and then price policyholder premiums accordingly. So in the case of property insurance, this would be, analyzing the likelihood of an event like a hurricane or a wildfire occurring to a specific property, and then determining, what the price of insurance is based on that individual property's risk. And that can apply to really any risk across the economy that you can think of. For pretty much any risk that's out there, there is insurance associated with that risk. So insurance being sold to kind of mitigate that risk. So this is anything from travel to cyber, the risk of cyber attacks, weather events, climate events, really anything that you can think of, anything you can think of that's risky has insurance associated with it. And so as this slide says, what insurance premiums boil down to, an insurance premium is the price of a risk associated with an individual, a property, or an item being insured. Again, using property insurance as an example, a premium is a signal of how likely it is that a business or an individual will lose money on a physical asset due to an adverse event. So now let's get into kind of the meat of this. What does insurance have to do with climate change? As it turns out, a lot. Climate change has amplified the frequency and severity of extreme weather events, as I'm sure we all know, because we're all here at this climate event today. More extreme weather equals increased financial risk to both individuals and businesses. And as we were just discussing on the previous slide, insurance is a business of risk management. So when the financial risk due to extreme weather events increases, that means that the price of insurance has to go up. And so, because insurance is a business of risk management, and insurers are supposed to be kind of the experts in predicting that risk, you would logically expect that insurance companies would be at the forefront of understanding and communicating the risks of climate change. There was an article in Forbes earlier this year that stated that climate risk affects both the assets and the liabilities of an insurer's balance sheet. And these companies should have the expertise in climate, as they process a vast number of claims that relate to climate-induced threats like hurricanes, wildfires, etc. Hence, if there was ever an industry where doing good coincides with doing well, it must be insurance. So are insurers actually at the forefront, as one would expect? Unfortunately, this has not been the case. And I'll talk a little bit now about why not. So as the frequency and severity of these extreme weather events has increased, the models that insurance companies have used for decades to predict the risk to physical assets like buildings and infrastructure have not kept up with the pace of climate change. And what that means is that insurers can no longer accurately predict risk in many parts of the world, which has led to a broken insurance market. If insurers cannot price climate risk appropriately, they lose money and can't provide insurance anymore. The impacts of this are immense. And what this means is that there is a fundamental lack of an ability to communicate and discuss the impact of climate risk on the financial futures of businesses and individuals. If insurance can't do it, then who can, you know? So, like I said, the impacts of not being able to appropriately communicate climate risk in financial terms has really immense impacts. And I'm going to walk through kind of the Florida case study to really illustrate what a broken insurance market looks like and can mean in a state that is currently experiencing an extreme case of a broken insurance market. So in Florida, as I'm sure we are all aware, there is a lot of risk of hurricanes. And in the last couple of years and decades, there has been an increasing likelihood of major damage from hurricanes, catastrophic damage that will wipe out homes and communities due to climate change. And someone has to pay for that, right? In all of the cases that you can think of recently, Hurricane Ian, Hurricane Andrew in 2004, 2005, it's insurance companies who are paying the damage for these catastrophic losses to communities and homes. And because, as we just discussed, insurance companies are no longer able to appropriately predict and price that risk, insurers are losing money. They're hemorrhaging money, really. And dozens of insurers in Florida have had to completely close up shop or stop selling new home insurance policies in the state in recent years because they simply cannot afford to operate anymore. What this has resulted in is that residents have increasingly turned to what is called Citizens Property Insurance Corporation. This is a public entity established by the Florida state government as the state's insurer of last resort for people who are unable to find affordable rates from private insurers. As all of these insurers have fled the state of Florida and stopped selling homeowners insurance there, it has driven up prices and it's made insurance increasingly unaffordable or even unattainable for certain properties. So a lot of people are not able to find any home insurance. They can't find a company who will give them home insurance in their state. And so they go to Citizens Property Insurance, where they're sort of obligated by law to provide home insurance, a basic level of home insurance protection for citizens of Florida. To kind of illustrate, the growth of the Citizens book of business, in 2019, Citizens had about 400,000 home insurance policies on its books, and today it has more than 1.3 million. 1.3 million home insurance policies are being underwritten just by Citizens alone, which is about twice as many as the state's next largest insurer. All of this pressure on Citizens property has put a ton of pressure on normal Floridians' pocketbooks. And the reason is because when a normal insurance company takes big losses, as is the case in a catastrophic hurricane, it would go bankrupt. That's not the case for Citizens. If, hurricane damage destroys too many homes covered by Citizens policies and the insurer faces bigger bills than it can afford to pay, state law mandates that Citizens imposes fees on private insurance policies across the state in order to cover its payouts. So this ends up hitting the people who are paying for private property insurance in Florida. And the crazy part is that it's not limited just to property insurance. So if you live in Florida and you have, you can't afford a home, so you don't have homeowners insurance, but you have a car and you pay car insurance. You may still be stuck contributing to funds that pay for homeowners to rebuild after a big storm. So this, immense kind of like buildup of pressure on citizens ends up in what is essentially a hurricane tax on all of the citizens of Florida. And this actually happened in the 2004-2005 hurricane season. There were 10 hurricanes that left Florida residents paying off $1.7 billion worth in damage. And that took about 10 years to pay off. So they were paying off this tab through 2015 through this essentially tax on their private insurance policies. So that kind of raises the question of, why is citizens being flooded with all these policies in the first place? One big reason, of course, is that, the private insurance rates are going up, or, it's just getting harder. The restrictions and qualifications that a house needs to have to obtain private insurance are getting a lot higher. But also citizens is legally barred from raising rates fast enough to stay in line with the private market. So private insurance rates in Florida have climbed sharply in recent years, and citizens rates are about 40% lower than the private insurance market. And recently, the state actually rejected a request from Citizens Management to impose a 12% rate hike. So by law, their rates are underestimating vastly the risk to homes. And so therefore, there's a lot of incentive for homeowners to pay this much lower citizens rate, even if the coverage that they're getting is a lot lower. And ultimately, this results in a tax and a burden on more residents in the long term, while it kind of, keeps rates artificially low for residents, provides them insurance in the short term. It ends up, applying this essentially hurricane tax to all Florida consumers. So this is an example of a broken insurance market that has directly resulted from insurance companies being unable to price and communicate properly the climate insurance or the climate risk to home properties in Florida. Of course, there are a lot of other impacts to, not being able to properly price risk as well. As the slide states here, shrinking property insurance availability and affordability has profound implications for the economy at large. Spending on housing accounts for about 17% of the US GDP. So if we're not able to, enable the housing market to continue as it has operated for many decades now, that has really profound implications for our economy as a whole. Living in disaster-prone areas is driving up living expenses and creating unexpected bills for millions of Americans. This is really, in Florida, as we were just talking about in particular, folks are seeing their insurance go from maybe $10,000 a year to $20,000. It's not uncommon for people to see home insurance policies in the many tens of thousands, depending on where they're located. And that's a massive increase in monthly expense for many Americans. Another, major impact of this kind of misalignment between risk and the climate risk and financial signal is that if insurers can't price this risk appropriately, they'll stop offering insurance in these risky markets, which means that individuals can't find or afford insurance for their homes. Some people will choose not to buy insurance at all, and won't be able to afford to rebuild in the event of a hurricane or a fire or a flood. And that means that they might have to move, or that, they end up homeless. Like there's a lot of kind of like adverse cascading effects as a result of that. It also has the potential to reshape local politics, economies, and cultures. Home values are declining. In a paper published in the journal Nature, researchers found that U.S. residential properties exposed to flood risk from 2020 to 2050 are currently overvalued by somewhere between $121 billion and $237 billion. So eventually, when this price signal does catch up to these homes, their property value is going to drop significantly. And that could lead to families leaving these areas, or families not even moving there in the first place as those property values go down, and as this kind of like alignment kind of comes back into balance. The flight of families can cause schools to close and businesses to shutter, which then creates a downward economic spiral that deprives local governments of tax revenues. Like, this can really be like a really kind of messy, downward spiral of a situation where home values go down. That means less people want to move there. That means businesses don't want to be operating there, which means tax revenues go down, which means we can keep going on and on about kind of the cascading effects of this. And then, finally, if insurance continues to incorrectly price risk, there will be insufficient incentives for investment in climate resilience. U.S. communities have kind of failed to date to require building and land use practices that mitigate risk. Most states don't adopt model building codes that offer significant protection against disasters. State and local governments haven't adopted codes that account for the risk of climate change. So even if a house is built to comply with the latest standards, it could encounter stresses brought by climate change that exceed what the code anticipates. So higher wind speeds, more rainfall, more wildfires, etc. And then communities haven't discouraged development in risky areas. So according to NOAA, the National Oceanic and Atmospheric Administration, 40% of Americans live in coastal counties, which makes up just 10% of US landmass. And then populations of southern states vulnerable to hurricanes and sea level rise, like Florida, Georgia, North Carolina, Texas, are increasing, not decreasing. And government programs encouraging people to move away from these risky areas can't keep up. In North Carolina, the state has a buyout program, which uses government funds to purchase high-risk homes, but they found that the state had 10 new homes constructed in the floodplain for every property removed from 1996 to 2017. So these problems are just getting worse, and they will continue to get worse if insurance companies cannot properly cannot properly signal climate risk to policyholders, because they won't understand the incentive to change behavior without kind of this root signal coming from the insurance companies. All right, so how, we've talked a lot about the problems in the insurance market right now, but how can an insurance actually be part of the climate solution? And this is really important because I think insurance is a part of the climate solution that people don't think about a lot. It's not as sexy as carbon capture or, carbon markets or, composting even, like there's a lot of like cool, exciting, new technologies coming out that will help us kind of fight climate. But insurance is really critical cornerstone of all of this. So what can insurance do to be part of the climate solution and help kind of influence and signal change, right? So one is that insurance can create incentives for investment in climate resilience. Mitigation needs to take a more prominent role to accelerate climate resilience. So, physical resilience equals financial resilience. This means that insurance companies need to come up with innovative ways to incentivize action. So there are companies that are, building in resilience credits into their premiums. So like they'll give their clients and customers a 5% premium credit that they can then use to apply to mitigate physical property risks. So like if they have a $1,000 premium, for example, they give them $50 to put towards some kind of mitigation project. Obviously, that's a small example. The amount would probably be much bigger than that. But they can apply that 5% credit to putting in solar panels, to create mitigate against power outages during a storm. They can use that money to shore up their roofs and their hurricane protections for their windows, things like that. And there needs to be more that needs to be core to any kind of property insurance going forward. Insurers can also encourage best climate practices among insurance companies and regulators. The National Association of Insurance Commissioners, which is a group of state insurance regulators, can work with state, local, tribal, and territorial governments, as well as insurance companies, to identify land use practices that increase the insurability of property. So really getting involved kind of at the ground level on, climate resilience projects and helping to create environments that are less susceptible to climate events. And then these state commissioners can also encourage using risk models that look at the future risk to inform premium pricing in ways that protect the interests of homeowners and insurance companies, as opposed to relying on these old school models that look at only historical data. We really need to be looking at future looking data, since climate risk is evolving so quickly. We can't rely on historical data to appropriately predict future risk. And then, we can create community insurance models. This is kind of a new concept, but community-based insurance plans can aggregate insurance purchases for a lot of households, and incentivize community-wide risk reduction measures. So like elevating homes to protect against flooding, removing dry vegetation to reduce wildfire risk, creating, solar farms to rely less on the electrical grid in case of emergencies, things like that, that can kind of encourage these, instead of relying on like individual house by individual house measures, really doing this at the community level, to kind of pool resources, and encourage entire communities to make these shifts. And kind of along the same lines, developing more innovative private insurance products. So insurance companies can identify innovative products that provide additional protections. So things like pre-disaster insurance. It can offer, like these types of policies could offer a payout before a disaster, which would allow homeowners to take measures to protect their homes. So that's kind of similar to the idea of like the premium credit, but giving them money up front to protect their homes, and make them more resilient prior to events, as opposed to, providing these huge payouts when something catastrophic does happen. Reactive measures always end up being much more expensive than proactive measures to protect a home. And so this could really go a long way in minimizing losses and minimizing disasters. And then there could also be multi-year insurance contracts that reduce pricing volatility. We have in the US this 1 year policy standard. So it's normal for home insurance to be annual. I'm sure many of you are aware of that and have experienced it. That means that insurance companies are really only incentivized to look at the risk of a property in the next 12 months. And that kind of reduces the window of, incentivizing those homeowners to reduce their risk. And it also means that every year, the insurance companies can reevaluate the price of that insurance, which means that it can fluctuate a lot. So like the incentive, it kind of hits on two fronts, which is one, the incentive isn't really there to protect a home long-term. And then two, it means a lot of volatility for the consumer. It's not a very good experience. And then the last two things are reducing insurance for industries that contribute significantly to climate pollution. So insurance companies can stop providing good coverage for, oil companies, and these companies that emit a lot of greenhouse gases. And then finally, insurance companies can adjust their own investments to help drive greater emissions reduction. So really aligning their investments of the money that they bring in through these premiums to better align with climate forward organizations. And then I'll just wrap up with this last slide, which is kind of, where this was a lot of like kind of doom and gloom, right? But like, where is the kind of hope here? And the good thing is that there are already signs of a shift in thinking. Investors are starting to have a shared language and framework for talking about climate risk in their portfolios. And there's really been a shift in the last few years to starting to think about climate as something that needs to be managed today, not in 5 to 10 years. So there's a lot more talk today about how insurance companies and their investors can really start to incorporate climate risk into their models. And this we are starting to see companies starting to model insurance price increases due to climate change into their financial models. So there's a lot of kind of like movement in the right direction here. And then the last thing is that customers want more information and want to take action. So they're also putting more pressure on these insurance companies to provide more information about mitigation measures that they can take. So that's all really positive and providing a lot of movement in the right direction. And then the last thing is that there are companies like FutureProof, my organization, who are trying to completely rethink the insurance industry and really put climate at the heart of what we do, and ensuring that we're good climate citizens, as well as encouraging an insurance kind of community that takes climate risk into account when pricing policies. So there's a lot of positive action that's happening in the world. And that is all I had for you today. So thank you so much for your time. Really appreciate you taking the time to learn a little bit more about insurance and how it's kind of critical to the climate solution.